So, Mapletree Logistics Trust just put out their latest quarterly results. And honestly, at first glance, the numbers might make you a little nervous. But those headline figures are really just the tip of the iceberg. The real story, the one with all the important details, is hiding just underneath. So today, we're going to dig deep into that Q2 performance, figure out what these numbers actually mean, and break down the strategy they're using to navigate the future.
Here's how we're going to break it all down. We'll start with those big headline numbers that probably caught your eye. Then, we're going to get into the why behind that year-on-year drop. After that, we'll look at how the core business is actually doing. Spoiler, it's pretty resilient. We'll cover their strategy for sprucing up their portfolio, and then we'll wrap up with a look at what's on the horizon.
All right, let's get right into it and take a look at the key financial results for the second quarter. Okay, so when you look at the numbers here, comparing this year to last year, you see a whole lot of red. Gross revenue is down, net property income is down, but the one that really jumps out at you, the one that matters most to investors, is that number at the very bottom, the distribution per unit, or DPU. Yeah, a 10.5% drop. That's the payout that goes to each and every investor. And a double-digit fall like that, well, that's a major red flag that definitely gets people's attention and makes shareholders a bit anxious. So the big question is, what on earth happened here? All right, so let's peel back the layers on that number, because trust me, it's not nearly as simple or as scary as it looks on the surface.
Turns out, two big things are behind most of that drop, and they have less to do with the day-to-day business than you'd think. First, foreign currencies got weaker against the Singapore dollar, so the money they made overseas was worth less when they brought it home. Second, and this is the real kicker, last year's numbers got a nice boost from a one-time gain of $6.1 million when they sold a property. That extra cash just wasn't there this time around, which makes for a really tough comparison.
And this is where you really see why context is everything. On the left, you've got that big, scary headline number, down 10.5%. But then look at the right. Once you pull out that one-time gain from last year to get a real apples-to-apples view, the adjusted drop is only 4.8%. Now that tells a completely different and much less alarming story about the health of the business.
So that brings us to the core of the business. What's actually happening on the ground? Because this is where we start to see a picture of real resilience that was hiding behind those headline numbers.
And right away, here's the first sign of that underlying strength. Their portfolio occupancy rate, which is just how full their warehouses are, actually went up this quarter. I mean, think about it. In a pretty tough economic climate, they went from 95.7% full to 96.1% full. It shows the demand is still there and people want their space. Now, this is really interesting. A little green shoot popping up in China. For a while, they've been dealing with something called negative rental reversions. A fancy way of saying they had to sign new leases for less money than the old ones. Last quarter, that was a pretty steep 7.5% drop. But look at this quarter. It's narrowed all the way to just 3.0%. That's a huge improvement and a really good sign that the market there might be finally hitting a bottom and starting to stabilize.
And you know who else sees this? Management. The CEO herself, Ms. Jean Kim, pointed to their resilient operational performance. Basically, what she's saying is, hey, forget that noisy year-over-year number for a second. If you just look at how we did from last quarter to this one, things are actually holding pretty steady. It paints a picture of a stable ship in some choppy seas.
Now, this kind of resilience doesn't just happen by accident. It's all part of a very deliberate, forward-thinking strategy they call portfolio rejuvenation. So, what on earth is that?
It's a really smart three-step playbook. Step 1, they sell off their older buildings, the ones that don't have much room to grow anymore. Step 2, that sale, of course, frees up a bunch of cash. And then step 3, they take that money and plow it back into brand new, modern, high-tech facilities, the kind of properties that are in high demand and are set up for future growth. It's basically trading up.
And get this, they're doing all this while being super smart about managing risk. Just look at their debt. In a world where interest rates are all over the place, a whopping 84% of their debt is either hedged or locked in at a fixed rate. That's huge. It basically means they're shielded from any sudden nasty surprises with their borrowing costs, which gives them a ton of stability.
Okay, so they've got a solid core business and a clear strategy in place. But what does the future hold? What's the outlook here?
Well, management's view is what you might call cautiously optimistic. They know the global economy is tricky. You've got trade tensions and all that, But they're not panicking. They're focused on the fundamentals they can actually control, keeping those warehouses full, keeping costs in check, and sticking to that smart portfolio rejuvenation plan. It's a solid, steady-as-she-goes game plan. So it all comes back to that iceberg, right? That headline number. That was just the tiny bit sticking out of the water. What we found underneath is a much more interesting story of a resilient business that's actively making moves. They're playing the long game here, trading up their assets. And the real question for investors is the one you see right here. In this shaky global economy, is this strategy of selling the old to buy the new going to be enough to deliver real, sustainable growth down the line?